Hello, Model Wealth community. My name is Donovan Sanchez, and I'm thrilled to be with you for this quarterly insight. Now, this is a time of year when many of us are reflecting on the past and we're thinking about the future. It's also a time when business professionals, market analysts, fund managers, and others are thinking about the future. And so it's likely that you'll receive a lot of feedback, a lot of information, a lot of inundation about market predictions, what's going to happen in the year to come. Now, this is pretty normal, right? The world is a chaotic place, and humans want to make order out of that chaos. Well, I'd like to share with you a few ideas, a few stories, a few data sets that I think will provide some compelling evidence that we humans aren't very good at predicting the future. Additionally, I'd like to leave you with a few ideas around things that you actually can do, right? If we can't really rely on market predictions, what recourse do we have? What are the things that we can do? Let's begin with a story about famed American economist, Irving Fisher. At one point in Mr. Fisher's esteemed career, he said this: "Stock prices have reached what looks like a permanently high plateau." Now, unfortunately for Mr. Fisher, he said this right before the stock market collapse of the Great Depression. Right? The timing could not have been worse. Now, think about this. This is one of America's premier economists, one of the brightest minds in this space, and in fact was completely wrong when it came to his market prediction. Now, things haven't changed much. Professionals have a very hard time predicting top performance. We actually have some data that provides evidence of this. So let's take a look at S&P Global's S&P versus active. So, well, what is this? So first, let's define some terms. When you're investing, you have some choices where you can put your money. You could put your money, for example, with an actively managed fund. This is a fund where there's a fund manager who's paid in order to pick and choose investments they believe are going to have superior performance in the foreseeable future. In contrast to that, an index fund simply tracks a collection of stocks. One index fund that you might be familiar with, or one index you might be familiar with, is the S&P 500. The S&P 500 simply tracks the 500 or so largest companies in the United States. Now again, we have kind of these options. You could just simply track the 500 or so largest companies and put your money with an index fund, or you could give your money to an active manager who's looking over things, they're paying attention, they're trying to pick and choose what they think are going to be the winners, maybe avoid the losers. Which funds tend to perform better? Well, if we look at this information here, again, just comparing funds to the S&P 500 index, 92.19% of funds underperformed the S&P 500. Well, there are a few funds, right? This is pretty compelling information that would suggest that, even the pros are not very good at just simply beating a plain vanilla S&P 500 index. Now, there were a few, and this is over a 15-year time horizon. 7.81% of funds did underperform the S&P 500 over that time horizon. The challenge is, however, how do we identify beforehand what those funds are going to be? Right? That's a very difficult thing to do. Those outperformers, who are they? It's very difficult. As we're looking over the next 15 years, which one is it going to be? So more often than not, much more often than not, in fact, historically speaking, one would be served better by putting their money with a plain vanilla index fund, right? That's the first piece that I'd like to review with you. Let's continue on. Now, let's imagine with me. Let's imagine that on December 31st of 2022, you went to sleep and you slept through all of 2023. And then you woke up today, right? I'm assuming that didn't happen for you, but let's just imagine that you did. And then I showed you these next few slides illustrating the challenges that we're facing in 2023, right? War in Ukraine continues, massive layoffs from large companies, earthquakes, failures of multiple banks, former president being indicted on other charges, right? And that's just the first half of the year. Here's the second half of the year, right? More challenges that you can see here, some of them very, very serious. Now, if I showed this to you, again, if you'd fallen asleep December 31st of 2022 and you woke up today, you missed a complete year, if I showed this to you, I think there's a strong likelihood that you'd say, well, 2023 was probably not a very good year for investing. Right, we're going to look at the data in a moment to see how the year was, in fact. But with all these horrible things that happen, all these difficulties, it would be very natural to say, oh, I don't think it's going to be a very good year. And in fact, think back to the beginning of 2023, how you felt, what the environment was like, what people were saying. All right, here's an interesting quote that I took from a recent Wall Street Journal article. It reads, "A year ago, everyone from the strategists at Wall Street banks to rap artist Cardi B was calling for a recession." Remember that? Everyone thought, okay, the Federal Reserve is raising interest rates. There's a strong likelihood that we're going to enter into a recession. Well, what actually happened? In reality, 2023 was a phenomenal year for investors. The S&P 500 returned 24%. Dow Jones Industrial Average returned 14%. And the NASDAQ Composite returned 43%. So again, our predictions, right? Even some of the brightest minds were wrong, right? We're off base, didn't predict with accuracy. So what is a forecast worth standing by? I'll tell you, it's not very exciting, but it is humble and it is truthful. And the market forecast is, I don't know what's going to happen next. Now again, this is not to say that we should just throw our hands up and resign ourselves. There's nothing that we can do. No, there certainly are things that we can do. But rather, this is a proclamation for us to be very careful about following the predictions that people make, even though those predictions are often very persuasive. So, if we can't reliably predict the future, what should we do? Well, one of the first things that we should do is remember the value of diversification, right? The reality is there are going to be companies that fail. And sometimes that failure is quick, comes out of the blue, and we just never would have suspected it, right? One of those examples could be the case of Enron. More recently, looking back on what happened in 2023, right? The collapse of FTX, and right, Sam Bankman-Fried, being convicted of stealing billions of dollars. So sometimes these things just happen out of the blue, right? Other times we can maybe see it coming a little bit more. But the point is with diversification, right? When those companies fail, we don't have too much of our money invested in those single companies, so we're able to weather the storm. Now, there's a flip side to diversification. We often think about it from a defensive standpoint, right? How can I avoid the losers, right? How can I avoid those companies that are going to fail? But remember, diversification also allows us to enjoy when things go right. It also allows us to benefit when companies have surges in value. So this is data looking from 2008 to 2021. The MSCI All Country World Index, over that time frame, had average annual returns of 7.3%, right? That's pretty good. But what if you removed just the top 10% of performers? Well, that performance drops to 2.5%. What if you remove the top 25% of performers? Well, removing that top 25% brings the average annual returns down to negative 3.8%, right? This is really interesting. In being broadly diversified, yes, we protect ourselves from some companies that fail, but we also benefit when companies succeed and do really, really well. The other thing that we can do is remain focused and committed to investing over the long run. From a historical standpoint, investors have been rewarded immensely for sticking out the ups and downs, for sticking out the scary and challenging things that we face and that we will face each and every year. Right? This is definitely not to say that every year there's going to be great performance, but it is to say that investors have historically been rewarded for sticking with it even during years that are very challenging, even during years of negative investment performance. Now, spend some time with me. This is one of my favorite data sets to look at. This is the performance of the S&P 500 index from 1990 through 2022, right? This is a 32-year time horizon, so a pretty long time horizon. What if you took $1,000 in 1990 and invested it? How would it perform if you just let that money sit there? Well, that money over that total period would have grown from $1,000 to $21,555. Wow, that is pretty good performance. That's a pretty good return. Now let's imagine that you were able to line up the individual days of investing from the best days to the worst days throughout that 32-year time horizon. And we started removing some of those best days. What would happen? What happens if you remove just the single best day? What about the 5 single best days? Or what about the 25 best single days? Well, if you were to do that, removing, let's say, the 25 best single days, your returns drop from $21,555 to $4,576. That is a significant drop. Now, why do I share this? Well, it's not uncommon for many people when the stock market is doing some scary things, or when there's scary things happening in the world, to think to themselves and say, you know what? I should get out. I'm going to lock in my gains, and I'm going to get out for the time being. Right? I'll get back in once the world looks a little safer, right? Or once the markets have calmed down. Now the challenge is, right, as we're looking to the future over the next 32 years, when are these best days going to come? When is that single best day going to be there? Those 5 best single days, 25 best single days. We don't know. We have no idea. Now, this is one of the reasons why we advocate for a long-term buy and hold strategy, as opposed to trying to tactically move out of investments into cash and back in, right? It seems that would be an extremely difficult thing. What if we miss the best single day? What if we miss the 5 best single days, right? Staying invested for the long term has real value, has real merit. It's also valuable to focus on those things that we can control, right? If we are in savings mode preparing for retirement, we can focus on our savings rate. Maybe we need to save more than we are. If we are in retirement, right, we can focus on our spending rate, right? How much are we spending from our portfolio? Do we need to dial it back a little bit? In some cases, for certain individuals, maybe they need to dial it up a little bit, right? We can also focus on our asset allocation, right? How we are investing, right? Probably doesn't make sense for most of us to have all of our money in stocks. We want some preservation. We want some balance. And so having an asset allocation that meets our needs, right, our predisposition, right, how risk tolerant we are, how much would it affect our lifestyle, our portfolio if we did see a massive reduction in stock value. So we can control that. We can control how aggressive we're being. We can also choose the type of investment accounts that we're using when we're saving, right? Or where we pull money from investment accounts, right? The type of tax consequences that we'll see from that. We can also be conscientious of the investment choices that we make and pay attention especially to the fees that we're paying, right? Jack Bogle, founder of Vanguard, I love what he said. He said, in investing, you get what you don't pay for, right? So the lower we can keep our fees, often the better, right? We get to keep more of that money as opposed to paying in fees. Right? It's also worth trying as best we can to not get too caught up in things that we can't control, right? Things that we can't control include investment returns. There will be bad years, right, over an individual's investment time horizon. We have to withstand that, right? That's the price that we pay to enjoy over a long period of time having favorable returns, right? We also can't control inflation, and while we can vote for people, right, we really can't control taxes. So let me leave you with a closing thought. This individual here, Benjamin Graham, this is Warren Buffett's mentor, he said that the primary reason why most investors fail as long-term investors is because they pay too much attention to what the stock market is doing currently. Right? In other words, and this is very normal, very natural, we can get too focused on the short term and we lose sight of the long-term perspective of our need to stay focused investing for the long term. So as best as you can, try not to pay too much attention to what the stock market is doing currently, right? It's normal to do that, but don't let it pull away from the long-term perspective. And so with that, I'll leave you with this thought again, right? The only market forecast worth standing by is I don't know what's going to happen next. Again, Randy, Alex, Anna, or myself probably are not going to get invited onto a news station to make that market prediction and say that we don't know. That's maybe not an interesting talking point that a news anchor would be looking for. but it is a humble answer, it is an honest answer. And again, there are things that we can do, but let's also be aware that we don't really know what's going to happen next. Let's be prepared as best as we can and stay committed for the long run so we can enjoy the fruits of a long-term investment focus. With that, my friends, thank you so much. It's been a pleasure being with you. If you have questions, comments, or feedback, please don't hesitate to reach out. Also, if you're interested in us speaking to particular topics in these quarterly insights, we'd love to do so. Thanks so much and have a wonderful day.